Liquidity sweeps. When you open the chart, the first thing you notice is price is making higher highs and higher lows. This tells you the market is in an uptrend. That already gives you an important rule. You are only interested in buying, not selling. In this uptrend, price moves in cycles. A strong, impulsive move upward, followed by a retracement. You do not enter during the impulsive move. You wait for the retracement, because that's where low-risk entries are created. During the impulsive move, price breaks above a previous resistance level. Once that resistance is broken, it becomes potential support. This level is now important because it helps you identify where the retracement may end. Price pulls back from the highs and starts moving down toward the broken resistance, now acting as support. At this stage, many traders panic, others enter too early. You do nothing yet, you wait. As price approaches the support level, something important happens. Price pushes slightly below support. Previous buyers get stopped out. Late sellers think the trend is reversing. This is the liquidity sweep. The market briefly moves lower, not to reverse, but to trigger stop losses, collect liquidity, prepare for the next real move. This is where most traders get trapped. After the liquidity sweep, price quickly moves back above support. A bullish pin bar candlestick pattern forms. This candle tells you sellers failed to continue lower. Buyers stepped in aggressively. The retracement is likely over. Now you have confirmation. At this point, all four concepts align. Uptrend, pullback into support. Liquidity sweep, bullish candlestick pattern. This is where professional traders enter. Not at the top, not in the middle, but after weak hands are removed. Let's take this trade setup. We place the entry at the close of the pin bar, the stop loss below the wick, and the target at twice the risk. Look at what happens next. Price reaches the target. This is not a holy grail. You will have losing trades, and that's completely fine. Losses are simply part of the game. Now let's look at a range-bound market and apply the same four concepts step by step. When you open the chart, you notice no higher highs, no lower lows, price moving sideways. This tells you the market is ranging. There is no trend. Your goal is not to chase breakouts, but to trade reactions at the boundaries. Next you mark resistance at the top of the range, support at the bottom of the range. These levels are respected multiple times, which confirms the range. Inside the range, you do nothing. All decisions happen at the extremes. After the liquidity sweep, price fails to hold below support. A bullish pin bar candlestick pattern forms. That candle tells you lower prices were rejected. Sellers are trapped. Buyers are stepping back in. Now you have confirmation. At this point, all four concepts align. Range market, support level, liquidity sweep below support, bullish candlestick pattern. This is where experienced traders enter long, targeting the move back toward range resistance. At this point, you might think you have everything you need, but there is one final concept that ties all the others together and filters bad trades. Top-down analysis. Top-down analysis means you don't trade in isolation. You use one trading time frame where you execute your trades, one higher time frame to define context and direction, nothing more. Your trading time frame is where you identify the market condition, draw support and resistance, spot liquidity sweeps, wait for candlestick confirmation. Your higher time frame answers one question only. Does the bigger picture support my trade idea? You don't need many charts. You only need one level up. If you trade on 5-minute or 15-minute, use the 1 hour as your higher time frame. If you trade on the 1 hour, use the daily chart. If you trade on the 4 hour, use the weekly chart. That's it. No confusion, no clutter. The higher time frame helps you. Avoid trading against major structure. Filter low probability setups. Stay aligned with dominant market pressure. You stop asking, is this a signal? And start asking, does this signal make sense in the bigger picture? Let me show you exactly how this works in real time. This is the New Zealand dollar against the US dollar on the 15-minute chart. As you can see, the market is ranging. Price has been rejected from this resistance level multiple times. So right away, we have two concepts in play. Market phase, we are in a range-bound market. Support and resistance. As you can see, this resistance level is a key level to watch. Now look at what happens next. Price reaches the same resistance level again. This time it breaks above it briefly and then closes back below, forming a doji candlestick. At this point, we add two more concepts. Liquidity sweep. Stops above resistance are taken. Candlestick signal, the doji shows indecision and rejection. Now we have 4 concepts aligned: range market, key resistance level, liquidity sweep, doji confirmation. And as we said earlier, in a range-bound market, you trade from the boundaries. So here all the criteria are met to look for a sell after the doji forms. There's only one last thing to check. Since we are trading on the 15-minute, our higher time frame is the 1 hour. Let's switch to the 1 hour chart. On the 1 hour time frame, you can see that the market is also ranging. Price has hit this resistance level twice, and each time it got rejected. This tells us that the higher time frame does not support a breakout. Instead, it supports a move back down, which aligns perfectly with our 15-minute trade idea. Now we go back to the 15-minute chart to execute. Entry at the close of the doji candle. Stop loss above the high. Target the next support level. Look at what happens next. Price moves down exactly as expected, respecting the range. At this point, you can see that profitable trading is not about complexity. You don't need dozens of indicators, complicated strategies, or constant screen time. What you need is a clear process that you repeat the same way on every chart. If you got value from this lesson, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss the next strategy. Thanks for watching, trade smart, and I'll see you in the next video.